Our next speaker is Lara Dalmeyer. Lara is an integral member of the Abax multi-asset team with a specific focus on fixed income. She is also quite closely involved with the management of the Nedgroup Investments Flexible Income Fund. So just given the volatile trading period, as we've seen in the first half of this year, excuse me, Lara will take us through fund performance, and she'll also just share in more detail her perspective and views in terms of the outlook for the rest of the year ahead. And just a reminder to please use that button at the top left to send through all your questions for the speakers. Lara, how are you?
Hi, thank you. Thanks for having me here today.
Great. Very welcome, and we're very pleased to have you here.
Thank you. Thank you.
Great. So we have about 15 minutes for the slides, and then we can take a few questions after that. Over to you.
Perfect. Okay, so today I'm talking about the global rate reset. But before we kind of jump into the nitty-gritty of what's happening in the markets, let me just give you a bit of a review on how the portfolio has done for the last quarter and the last year. It's certainly been an incredibly tumultuous period for financial markets. We've seen a huge amount of volatility, but over the last quarter, the fund has managed to deliver a gross return of 1% and of 6% for the last year. So what has been the reason around, what these incredibly volatile markets? We can largely attribute this to the fact that central banks have increasingly needed to react more aggressively to what seems like perpetually higher than expected inflation prints. So not only has the market had to digest higher rates, but it has also had to digest the fact that this could lead to a recession, particularly in the developed market, but also globally a lot quicker than what was initially expected. So given this backdrop, it has been exceptionally difficult to generate returns in bonds. This would include SA nominal bonds as well as offshore bonds. And it's also been hard to generate any returns from like high beta market sectors like SA property or offshore property. But where we have managed to generate some return is through our exposure to floating rate notes. As interest rates move higher, naturally the yield in this component moves higher, and we have managed to generate some returns there. Inflation-linked bonds have marginally contributed to returns. Naturally, this higher than expected inflationary environment has been very positive for this asset class, and it's actually provided a nice hedge to the portfolio over this volatile period. And then the other thing that's obviously done well for the portfolio is the fact that we hold hard currency and dollars in particular. So although it looks like we've managed to generate returns from the offshore component, that is largely driven by a rand weakness theme, as opposed to actually seeing returns from the underlying bonds. Pref shares also over the last year have managed to contribute positively to returns, and that's largely been off of the back of institutions buying these back at very attractive prices. So that's just a bit of a review on how the fund has done. Naturally, we are very happy that we've been able to preserve capital over this period. But as you've seen, markets have made it an exceptionally difficult time to generate excessive returns. So just to give you a bit of a reminder on how this portfolio works and what the investment philosophy is that we follow what is called a diversified alpha approach. So what this means is that we monitor a large variety of asset classes across the market, and we consistently keep on top of where we think the valuations of these various asset classes are. What this means, because we have a large variety, it means that in general, the portfolio is going to be quite nicely diversified. You're going to have a large variety of alpha drivers in the portfolio. But what's particularly attractive about this approach is it means that we are also not forced into holding asset classes where we don't think the risk-return payoff profile is in our favor. If we think an asset class looks expensive, we would rather avoid it for a period of time and try and allocate that capital towards an asset class where we rather see a more favorable return payoff profile. And that is the diversified alpha approach followed by this portfolio. So to get onto how we see markets at the moment, I'm going to start a bit with the global backdrop. Naturally, we've been operating in a market that is very macro driven and predominantly off the back of what's happening in the developed market. So I'm sure you're all sick to death of hearing about this very high inflationary environment that we find ourselves in. I think everyone is very well aware that inflation globally is a very big problem. And I think, particularly looking at the US, you can see just how big this problem is. So if you look at the left-hand chart, you can see US inflation. This is headline and core in light green, going back to 2017. On average, we've gotten used to that kind of around 2% print, but you can see in recent times just how extreme these CPI prints have been. And actually, as last week, this was before the slide was submitted, just afterwards, the most recent CPI print became available. And although the market was expecting a very high 8.8%, again, the CPI print surprised everyone and came out at 9.1%. So this pattern of coming out perpetually higher than expected is continuing. And yes, it is still largely driven by oil and food prices, but you are also seeing stickier elements of the basket remain high. Elements in particular that stand out would be owner's equivalent rent and tenant's rent. That's an element seen in the core basket. And despite what's happening in the housing market, those inflationary elements are still remaining quite sticky in the basket. So it's a very difficult conundrum that the Fed is faced with at the moment. We did, towards the end of the quarter, see something quite interesting, though. You've been seeing these very high prints, and as a result, you would naturally expect rates keep moving higher and higher as the market expects that the Fed and other central banks would need to react in a greater manner. Towards the end of the quarter, though, we saw the US 10-year reach almost 3.5%, and in the last week, rally down by more than 50 points to about 2.8, 2.9%. So that was quite a contradictory market reaction. And I think you are starting to see these small rallies happen off the back of what is bigger recessionary fears. So we've always known, yes, as they hike rates, the chances of a recession happening sooner are greater. But I think that the market over the last quarter has started to digest that potentially this recession might happen sooner than what was initially expected. So one of the prints that kind of precipitated this rally was the print of the Atlanta's Fed GDP Now. So what GDP Now is it's the most up-to-date estimate of where the real GDP print for a particular quarter will come out. So the Q2 2022 real GDP estimate throughout, if you look April, May, at the blue chip consensus and the GDP Now estimates were signaling you were going to get a nice positive real print. Right at the end of the quarter, as more and more data became available, the Atlanta Fed signaled that actually the GDP Now estimate is now in negative territory, which, if this turns out to be true, means that this will be the second negative real GDP print for the US, which means technically they would be in a recession already. So it will be interesting to see whether this actually turns out to be true. But I think the data has started to come in a lot weaker than what many anticipated, and a lot quicker than many anticipated. So despite this little rally towards the end of the quarter, the overall move and overall re-rating has been incredibly significant. And I think it's important to give investors just a bit of context as to how significant this re-rating has been. If you look at the left-hand chart, we've shown you the returns of a couple of large bond indices across the world. And those are the returns for the quarter, the second quarter 2022, as well as the year to date. And if you look at US Treasuries, for example, that index is down almost 15% for the year. You can see similarly large, negative, terrible returns in the investment grade corporate bond space in the US, in the high yield corporate bond space in the US, in European bonds, as well as dollar emerging market bonds. So there has been an incredible amount of pain experienced in global fixed income markets through the year. And what's interesting is you've seen this incredible drawdown, but now if you look at the yields on the right-hand chart, you can see that in the US in particular, and some other markets, some opportunity is starting to present itself. Now, the question is this the time for us to start adding offshore duration? And the answer to the question is, well, we're still relatively uncertain about that. So if you look at the US in particular, with the 10-year yield at about 3, we would say over a long-term cycle, it's probably at around fair value. But given the inflationary pressures, the high inflationary pressures, we are not sure whether this is presenting value in the short term. And there is a potential that yields will need to move a lot more. Now, in the scenario where this is the peak of inflation, the tightening measures that have been put in place, and that would be around hiking rates, the end of QE, and the fact that central banks are now actually going to be selling bonds back into the market, and that is called quantitative tightening, and that needs to happen. The fact that we have seen high inflation in itself is in itself quite a tightening mechanism. All these mechanisms could come into play a lot quicker, in which case, if we see inflation roll down sooner, that means that the demand side of the basket has been dampened, food prices stabilize, oil prices stabilize, then it's very plausible that the amount of hikes the market has priced in is sufficient. And then in which case, that would probably be, quite a fair purchase at this point in time. But there are still so many uncertainties around where rates could go. We keep seeing upward surprises. There's still a lot of instability around food prices, around oil prices. And should the Fed strictly stick to their mandate and maintain that, whatever economic pressure might be suffered, they will bring down inflation, and inflation remains high, then it is very likely that we will have to see higher rates in the short term. It's important to note that never in history has high periods of inflation been successfully battled without positive real rates. So if inflation remains sticky and high around 3 to 4, then unfortunately global DM rates still have a little while to go. When I talk about value in the DM space, I'm particularly talking about the US. There's some opportunity in the UK, a little bit in Europe, but naturally the big exception to this would be Japan, where we are seeing a lot of yield curve control still happening. If we kind of turn now to the local market, we can see that in a similar way, the local market is pricing in a lot of interest rate hikes. You can see from the left-hand chart, which is the FRA curve, that in the next 2 years, the market is expecting the repo rate to be over 8%. So that is an incredible amount of hikes still to happen, given that the repo rate is currently at 4.75%. If we look at the right-hand chart, those are the inflation forecasts that we see in the market at this point in time. And you can see that hiking is necessary off the back of the fact that we are well above the upper band of the inflation target for the foreseeable few months. We think that inflation will peak above 7.5% in October. But the South African dynamic is a little bit different. Yes, we are seeing high inflation, but it is not nearly the same kind of extreme scenario that we are seeing in developed markets. And it's not demand side pressure pulling SA inflation higher. It is predominantly food and oil prices and all external factors. These are things that hiking doesn't necessarily solve. And we also have a very, very difficult growth dynamic locally. Growth remains extremely dampened, and we don't really see anything that's going to lift that in the short term. So given those two facts, we think that in all likelihood, the market is still pricing in too many rate hikes than what we will see. So yeah, on balance, we think that it will likely be less than what the market is currently pricing, although we do expect a 50 basis point hike in the next 2 meetings. So we have been big proponents of SA government bonds. We have, for a while, thought that they look incredibly attractive. Unfortunately, they keep looking more and more attractive. But if you look at our fair value model, and we have proprietary internal fair value models where we try and assess how cheap or how expensive an asset class may be. And if you look at an SA 10-year bond, we think that at this point in time, they're almost 1% cheap. So the fact that the implied risk premium in the pricing of South African government bonds is so high, we think that it does make it an incredibly good buy at this point in time. So the implied risk premium is now, well, at the end of the quarter was 5.1%. It is now probably a good 50 basis points higher than that. And this is what has happened in July so far. And this is an incredibly big risk premium to be baked into these prices. And this is off the back of the fact that that the South African fiscus is a lot stronger than what it's been over the last few years, and that would naturally be off the back of strong commodity prices and increased tax revenues off the back of that. So given the amount of fat baked into the valuation of South African government bonds, we do still think that this is a very good time to be running higher duration than what we naturally or on a more neutral case would run. The rand, the ever volatile rand, what our views there. So when we try and think of the valuation of a currency, we run what is called a PPP model, a purchasing power parity model. And what that means is that we depreciate the rand by the inflation differential between us and all of our trading partners. And that should give us a purely theoretical indication as to how cheap or how expensive the rand is. On that metric, it tells us that at a dollar spot of 16.75, the rand is cheap. But then, as we know, there are various fundamental factors that also drive currency strength or currency weakness. Two quite prominent factors will be if you are structurally running fiscal deficits or fiscal surpluses, current account deficits and surpluses, and we've seen just how big an effect that can have on a currency, and also what is the growth trajectory for the sovereign. The fact that generally we trade fiscally in a deficit, structurally, although currently we are seeing current account surpluses, that will move back into deficit territory, and we are a very low growth nation. Generally, we would say that the rand needs to trade cheaper than what a pure PPP model would show us. So at 16.75 spot, we think the rand is slightly cheap. So that would surprise many of you, I'm sure, given just how big a move the rand has seen. It is important to note, though, that this valuation is on a weighted basis between us and other currencies. So this would include how the rand is trading against the euro, how the rand is trading against the pound, etc. And what we've seen now is largely a dollar strength story. Oh, sorry, my mic is falling a bit. It's largely been a dollar strength story. The fact that the rand dollar spot rate is looking so poor is not necessarily just rand weakness, it is actually dollar strength. And you haven't seen that same move in other cross currencies. So just to give you a bit of a summary on what the portfolio looks like at this point in time. So we have about 37% of the portfolio invested in floating rate bonds. This provides a nice yield underpin for the portfolio. We are getting probably about 1.8% above JIBAR there, so it does provide a nice low-risk diversified element to the portfolio. We are running slightly higher duration off the back of the fact that we are bullish South African government bonds, and that would be a 23% allocation. We still have 12.72% to inflation-linked bonds, despite the fact that we like nominal bonds more than inflation-linked bonds. Short-term inflation-linked bonds have done very well and remain quite attractive and remain a nice hedge to the portfolio should we keep seeing these inflationary overshoots. We then have 2.5% to SA property. It's quite a neutral position. It's not an asset class we're particularly bullish on, although aesthetically it does look quite cheap. And then I would say the other big asset allocation just to discuss is our offshore allocation. As I mentioned, it's hard for us to really decide that it is time to go or lean hugely into offshore duration. So what we have opted to do there is to buy bonds that are short in term, low in duration, but where we are getting the benefit of increased yield. And the fact that we are seeing these inverted developed market yield curves has allowed us to take advantage of those opportunities quite nicely. And with that, I will take any questions.